Hello dear friends, welcome back. Previously, we explored the importance of credit history and financial analysis in microfinance, focusing on how MFIs assess the creditworthiness of clients without formal financial records. Before introducing today's topic, I want you all to meet Leela. She owns a small vegetable stall in a village market. Like many entrepreneurs in rural areas, Leela lacks access to traditional banks and relies on microfinance to fund her business. But how do microfinance institutions decide how much Leela can borrow? And how do they ensure that she can repay her loan without falling into debt? And how do they ensure that she can repay her loan without falling into debt? In microfinance, determining the right loan amount and creating a suitable repayment schedule are critical steps to ensure both the borrower's success and the sustainability of the microfinance institution. Today, we will explore the factors that influence these loan amounts, how repayment schedules are structured, and how MFIs balance borrowers' needs with institutional stability. Here we go with factors influencing the determination of loan amount. The first step is determining a loan amount is understanding the borrower's financial situation. In microfinance, many clients have irregular or seasonal incomes, which makes it harder to predict their ability to repay. Microfinance institutions gather detailed information on the borrower's income and financial situation. For borrowers with stable incomes, such as small business owners or salaried workers, MFIs can offer larger loans. However, those with irregular or seasonal incomes, like farmers or informal workers, may only qualify for smaller loans to reduce the risk of defaults. Starting with our first factor, purpose of loan. So the purpose of the loan is another key factor in determining its size. Business loans are generally larger and tied to the potential profitability of the borrower's enterprise. In contrast, loans for personal or emergency needs such as medical bills or education fees are often smaller with shorter repayment terms. Our next factor is borrowers' existing debt and financial obligations. Borrowers with existing debt face additional challenges. MFIs assess the borrower's debt to income ratio, which measures how much of their income is already committed to repaying loans. If this ratio is too high, the MFIs may reduce the loan amount or even deny the loan altogether to avoid overburdening the borrower with debt. Next point, economic and market conditions. Economic and market conditions also influence loan amounts. For example, agricultural loans often depend on the seasonality of income. During planting or harvest seasons, farmers like Leela may need larger loans to invest in supplies, equipment, or labor. However, their ability to repay will be constrained by the seasonal nature of their income. MFIs take into account external factors like market volatility and economic downturns to ensure borrowers can repay even during tough times. Now, let's look into the structuring and repayment schedule. Once the loan amount is determined, the next step is to design a repayment schedule that fits the borrower's cash flow. This includes deciding the loan tenure and the frequency of payments. Starting with loan tenure. Loan tenure refers to the time over which the borrower must repay the loan. In microfinance, loan tenures are typically shorter than in traditional banking, ranging from 6 months to 2 years. For small short-term loans, a 6-month repayment period might be appropriate, while larger business loans might longer repayment terms to give the borrower time to generate income. Next point, repayment frequency. For borrowers with small, frequent incomes, such as petty traders or daily wage earners, weekly or bi-weekly payments are quite common. These smaller regular payments are easier to manage for those with unpredictable incomes. However, borrowers with more stable incomes may prefer monthly payments to reduce the administrative burdens. Thirdly, flexible versus fixed repayment schedules. In some cases, MFIs offer flexible repayment schedules that allow borrowers to adjust payments based on their cash flow. This is especially useful for clients with seasonal or irregular incomes like farmers. However, flexibility comes with risks, as it may complicate loan tracking and increase the risk of defaults. Fixed repayment schedules, on the other hand, provide predictable payments at regular intervals, which simplifies budgeting for both the borrowers and the MFIs. Now let's look into our next important element, interest rates and loan pricing. Interest rates in microfinance are typically higher than in traditional banking due to the increased risks and operational costs of serving low-income borrowers. MFIs must carefully set interest rates to balance sustainability with affordability. Key points to be considered. Factors influencing interest rates. Operational costs are a major factor, as MFIs often need to send field officers to visit borrowers to remote areas. Additionally, because MFIs serve clients without credit histories, they face higher risks of default, which are factored into the interest rates. Secondly, balancing affordability and sustainability. While high interest rates are necessary for the sustainability of MFIs, they can be a burden for borrowers with low or irregular incomes. To mitigate this, many MFIs use the declining balance method, where interest is calculated only on the remaining loan balance. This method helps reduce the total interest paid over time. Flat interest rates, where interest is charged on the full loan amount for the entire tenure, can lead to higher total. Moving on to our next element, aligning loan amount and repayment schedule with MFI sustainability. While MFIs tailor loans to meet borrowers' needs, they must also ensure their own sustainability. This involves monitoring loan performance, minimizing default rates, and managing operational costs. Firstly, Portfolio at risk, commonly called as PAR. Portfolio at risk is a key indicator of an MFI's financial health. It measures the proportion of loans that are overdue. A high PAR signals that many borrowers are struggling to repay, which can threaten the institution's stability. Next, loan monitoring and follow-ups. Regular monitoring and follow-ups are very much essential to keeping borrowers on the track. Field officers play a crucial role in visiting borrowers, offering financial advice, and addressing any issues that arise during the loan tenure. Many MFIs are now using digital tools to track loan performance and send automated reminders to the borrowers, reducing delinquency rates and improving overall portfolio health. Therefore, in conclusion, by striking the right balance, microfinance institutions can promote financial inclusion and help borrowers like Leela achieve lasting economic success. So, with the right loan and manageable repayment plan, borrowers can build their businesses, support their families, and ultimately contribute to the economic development of their communities. So, dear friends, remember, MFIs are transforming lives with one loan at a time. Stay tuned and stay connected as we will meet with more interesting topics in our next session. Thank you.